Central banks are preparing to launch a new kind of currency. These are not cryptocurrencies, nor are they merely digital versions of cash. They are CBDCs, Central Bank Digital Currencies, and they represent more than an upgrade to our financial systems. They signal a deeper shift in how money functions and how individual freedoms could be shaped by code. CBDCs are programmable, trackable, and deeply integrated with digital infrastructures. While often promoted as innovations for efficiency and inclusion, they are quietly introducing a new paradigm of monetary control. This is not just about payments, it's about power. A CBDC is digital money issued directly by a central bank. It is not backed by a commercial bank or a private blockchain. It is legal tender, regulated and centralized, but it moves with the speed of modern technology. There are two main versions: retail CBDCs, which are designed for everyday use by the public, think groceries, rent, subscriptions. And then there's wholesale CBDCs, which are limited to financial institutions for large transactions, settlements, and liquidity management. The promise is speed, efficiency, financial access. But beneath the surface, as many of us already know, these digital currencies come with capabilities that have never existed in cash or traditional electronic payments. So why the urgency now? Well, ultimately, CBDCs have little real use case. Indeed, the president of the Federal Reserve Bank of Minneapolis admitted this publicly here. The counter-argument is that several converging forces are said to explain the sudden global momentum behind CBDC development. The first of which is said to be the explosive rise of cryptocurrencies, which is said to have challenged state monetary sovereignty. Stablecoins and decentralized finance platforms appear to offer alternatives to fiat money and traditional banking. This attracted capital and users worldwide. Meanwhile, private tech giants have also launched digital wallets and proposed their own digital currencies, which appears to threaten or capture payment networks at a global scale. So CBDCs offer a state-controlled response. They allow central banks to modernize the monetary system while reasserting control over financial flows. In a world rapidly encouraged to go cashless, CBDCs are said to ensure that public money remains relevant and programmable. Another reason given for introducing CBDCs is the need for faster and more transparent cross-border payments. But this issue is already being addressed. Existing systems using ISO 20022 and upgraded settlement infrastructure are improving speed, cost, and data quality. CBDCs do not offer a clear advantage here. Their main feature is programmability and centralized control, not efficiency. The case for CBDCs is less about solving real problems and more about expanding the reach of financial authority. Behind the public-facing rationale of innovation and inclusion lies a deeper objective: shaping the rules of the next financial era before private actors take back their own power. CBDCs are being designed in parallel with deeper changes in global finance. The Bank for International Settlements Innovation Hub is coordinating multi-jurisdictional experiments that reveal how these digital currencies will operate across borders. Project Dunbar connected multiple central banks to allow international settlements without traditional intermediaries, laying the groundwork for a globally coordinated CBDC system with centralized oversight. Project Helvetia proved that tokenized securities, which we'll consider in upcoming episodes, can be settled using a wholesale CBDC. This showed how programmable money could reshape institutional finance, fast, traceable, and tightly controlled. Project Icebreaker demonstrated retail CBDCs working across 3 different nations, with foreign exchange conversion built into the architecture, proving how everyday payments could be monitored, regulated, and conditioned across borders. Each of these projects push CBDCs closer to interoperability, compliance, automation, and real-time programmability. But these features are not just about making systems more efficient, they are about building digital rails that governments and institutions can use to direct behaviour. CBDCs are not being created in isolation. They are being embedded into a broader upgrade of financial institutions that we considered in the previous episode in this series. The ISO 20022 messaging standard is being adopted by central banks and payment providers worldwide. It allows for rich transaction data, tagging, and traceability. This is key for integrating programmable features into financial flows. Real-time gross settlement systems, RTGS, the core engines of interbank money movement, are also being rebuilt. These upgrades make CBDCs compatible with existing financial plumbing while adding capabilities that cash and legacy systems could never support. Together, these elements form a programmable and trackable ecosystem where money is no longer just a neutral medium. It becomes a tool that can be shaped, directed, and even restricted. CBDCs are often described as digital cash, but this comparison is misleading. Unlike cash, which is private and unrestricted, CBDCs can be controlled at the point of transaction. Time-limited funds could be programmed to expire if not used within a certain time frame, nudging people towards consumption. Geofenced payments could restrict spending to specific locations, targeting aid or controlling movement. Conditional transfers could enforce compliance before funds are actually released, automating tax collection or benefit rules. Now, these are not hypothetical scenarios. Central banks have already tested such features in pilot programs. While marketed as tools for better policy delivery, they introduce the possibility of a future where access to money is conditional, temporary, or limited by algorithms. For consumers, CBDCs may bring faster payments, lower fees, and greater access to financial services, but they also introduce a shift to the relationship between individuals and the state. With programmable money, spending could be monitored in real time. Behavioral data can be extracted at scale. Financial censorship could become automated. The very act of transacting, once a private decision, could be evaluated against policy goals, risk models, or social criteria. For banks, CBDCs could erode deposit bases as individuals opt to hold digital currency directly with central banks. This could change how credit is created, how risk is managed, and how crises unfold. For governments, the appeal is clear. CBDCs offer unparalleled oversight and control and the potential for totalitarianism. But they also pose a stark question. How much control can a government wield before individual freedom is no longer freedom at all? And what, if anything, will stand in the way of financial authoritarianism in a fully digital system? The dangers of CBDCs are not being debated openly. Once programmable money becomes the norm, the freedom to transact could depend not on personal wealth, but on compliance, behaviour, or digital identity. Yet we must remember that this push is not coming from strength. It is not bold, it is desperate. Central banks and global institutions are not innovating with confidence. They are reacting to a world where trust is eroding quickly and control is slipping. They have not simply lost control, they've updated it. The same forces that have allowed apparent decentralization to flourish may have been watching, shaping, even steering it. Now they are repackaging those lessons into a system that looks modern, seamless, and efficient, but functions as a final enclosure. Their solution: turn money into code they control. Wrap it in surveillance, compliance, and restrictions, not because they are visionary, but because they are afraid. This is not the behavior of leaders. It is the scramble of insecure gatekeepers trying to reassert authority over a system that has already moved beyond them. But here's the good news. Cages built in fear are rarely stable, and those who recognize them early are the most likely to walk free. We're not powerless. Awareness is armor, and resistance is key. We can either inherit a system designed to monitor us or help build one that respects us. That choice still belongs with us for now. Thanks so much for joining me. Do consider subscribing, and I look forward to seeing you next time. Bye bye.